Usually when we look at a medical diagnosis, there's this comforting expectation of absolute precision.
Right, like it's just binary.
Exactly. You break your arm, the x-ray shows that jagged white line, the doctor points to it, and that's it. Broken or not broken.
Yeah, it's right there in black and white.
But when you step into the world of corporate finance and you start parsing through these earnings reports, that x-ray machine is, well, it's fundamentally broken.
Oh, absolutely. It's diagnostic muddy waters. By design, really.
By design. Because corporations, they want to highlight all the shiny objects.
Right. They want to show off the good stuff and completely bury the structural decay deep in the footnotes.
Which is exactly why we're taking a scalpel to Garmin's Q4 and full year 2025 earnings transcript today. Welcome to this Talk Tickers Deep Dive, by the way.
Glad to be here. We've got a stack of freshly printed transcripts to go through.
We do. And our mission today is to cut through all that corporate jargon, deliver a rapid-fire data-forward analysis of how Garmin, that's ticker symbol GRMN, actually performed.
And we're going to give you, the listener, an actionable, highly opinionated bottom line.
Yep, all structured around our forward Talk Tickers pillars. So we're going to hit the headline numbers, the story behind those numbers, management guidance, and finally, the bottom line.
Love it. Let's just rip the Band-Aid off.
Let's do it. So looking at the raw data Garmin just reported, the anatomy of this company is going through this massive, unprecedented growth spurt for a legacy hardware manufacturer.
It really is. We're talking about a company that's been around for over 36 years.
Right. Let's look at the sheer physics of what they just pulled off in Q4. Revenue hit $2.1 billion.
Wow. Yeah, that
is a 17% year-over-year increase. But more importantly, it is the very first time Garmin has ever breached the $2 billion mark in a single 90-day window.
And, you really have to stop and think about the logistics of that.
Right, physically moving the goods.
Exactly. Pushing $2 billion worth of physical electronics out the door in 3 months. We're talking watches, chart plotters, avionics gear.
It's a logistical marvel.
It is. Millions of individual lithium-ion batteries, specialized screens, silicon chips. All of that has to be sourced, assembled, packaged, and shipped globally.
And when a company that old suddenly finds a new gear to break a psychological barrier like that $2 billion quarter,
it signals a structural shift in market demand. It's not just, a lucky holiday season.
Yeah, and it completely scales up when you look at the full 12 months, too. For the full year of 2025, revenue came in at $7.25 billion.
Which is a 15% jump from the previous year, right?
Exactly. To put that in perspective, they added nearly $1 billion in net new revenue to their top line over 2024.
That's like incubating a highly successful mid-cap tech company inside your existing operations in just one single year.
It's wild. And the profitability tracked right alongside it, Full year pro forma earnings per share came in at $8.56.
Up 16%.
Yep. And Q4 EPS was $2.79, also up 60%. But honestly, to me, the top line revenue is actually the least interesting part of this entire report.
Okay, that's a bold take. Why is that?
Because the metric that absolutely demands your attention is the operating margin. In Q4, their operating margins expanded by 60 basis points to 28.9%.
Yes. The margin expansion, that 60 basis point expansion is, it's really the hidden architectural triumph of this entire earnings report.
So translate that for us, because earning more is great, but how did they do it? Expanding your operating margins while dealing with new global tariffs.
It's insane.
It's like a sprinter setting a new personal record while wearing ankle weights.
That is the perfect analogy. So to understand why it's so impressive, in plain language, you have to look at the macro environment they're in.
Right, the 2025 tariffs.
Exactly. Early in the year, this wave of generationally high 15 to 20% tariff structures took effect across the whole global electronic supply chain.
Ouch.
Yeah. And simultaneously, the industry was hit with severe memory component constraints.
Like NAND flash and DRAM.
Right. The essential memory chips inside literally every smartwatch and navigation unit they make, the cost of those just spiked.
So their raw materials got significantly more expensive, and the geopolitical cost of moving those materials across borders just skyrocketed.
Exactly. Now, in a normal hardware business, those external shocks immediately compress your margins.
Right. You either eat the cost, which destroys your profitability,
or you pass the cost to the consumer, which destroys your sales volume.
But Garmin somehow avoided both of those traps.
They did. They held the line on the cost of goods sold in a highly inflationary environment. Gross margins stayed remarkably steady at around 59.2% for the quarter.
So getting that operating margin up to 28.9%.
It means they found incredible leverage in their internal machinery. They aren't just selling more stuff, they're fundamentally more efficient.
They kept more profit from every single dollar coming in.
Right. They managed their research and development spend and their general administrative expenses so tightly, they actually kept more money than they did when the global economy was less volatile.
That's incredible. But, numbers in a vacuum are meaningless without understanding the engine driving them. Let's pivot to pillar 2, the story behind the numbers.
Let's do it.
Because I look at their ability to absorb those tariffs without bleeding out, and it all points back to their manufacturing philosophy.
It's a vertical integration.
Exactly. So many consumer tech companies operate on a fabless model. They design a sleek product in a glossy office in California.
And then they just email the CAD files to a third-party manufacturer in Asia to actually build the thing.
Right. It's like renting a house. You have shelter, but you are entirely at the mercy of the landlord when the roof leaks or the rent goes up.
But Garmin, conversely, owns the house.
They are completely vertically integrated.
And that vertical moat is the single biggest defensive weapon Garmin possesses. They own their massive manufacturing facilities in Taiwan.
And aren't they building a new one?
Yeah, they're currently bringing a massive new factory online in Thailand, scheduled for early 2027.
Wow. So when you control the factory floor, you aren't paying a margin to a middleman like Foxconn to assemble your devices.
Right. Your baseline cost structure is just fundamentally lower.
Which means when a 15% tariff hits or a memory chip doubles in price on the spot market,
Garmin has a much thicker cushion to absorb that blow before it ever threatens their bottom line.
Okay, but I'm going to play the skeptic here for a second.
Go for it.
Wait, if memory costs are rising across the entire tech sector and tariffs are biting, isn't Garmin just masking a future profitability cliff by burning through cheap inventory right now?
Oh, that's a great question. And the transcript actually revealed a fascinating detail about that. The CEO explicitly mentioned using inventory as a strategic weapon.
Meaning what? They're intentionally hoarding critical components.
Yes. It is a highly sophisticated application of working capital.
Because most companies hate hoarding inventory, right?
Right. Many modern companies worship at the altar of just-in-time manufacturing. They try to keep inventory levels as close to zero as possible to save on warehousing costs.
But Garmin does the opposite.
Garmin operates on a just-in-case model for critical silicon. When their procurement algorithms detect a coming supply chain shock,
or a fluctuation in memory prices.
Exactly. They deploy their massive cash reserves to buy up vast quantities of components at current prices and physically warehouse them.
They essentially act as their own hedge fund against supply chain volatility.
That's a great way to put it. So when competitors are forced to halt production because they can't source DRAM, or they have to pay a 40% premium on the spot market,
Garmin is just quietly pulling from a stockpile they bought a year ago at a massive discount.
Exactly. And because their overall margin is so high to begin with, a slight increase in the bill of materials, the BOM cost is barely a blip on the radar.
Right. They can just tweak a manufacturing process in their own factory to find a few cents of efficiency somewhere else to offset it.
Which allows them to maintain price stability for the end consumer.
Speaking of the consumer, let's look at what's actually selling. Because the primary driver of this $2 billion quarter wasn't Garmin aggressively hiking prices to compensate for tariffs.
No, not at all. It was the fitness segment.
The fitness segment was the undeniable star. It surged an unbelievable 42% in Q4 alone.
And for the full year, fitness hit $2.36 billion. That's a 33% growth rate.
And management was heavily pressured by analysts on the call about this exact point, right? Is this just an illusion created by higher average selling prices?
Right. They wanted to know if Garmin was just charging more per watch. But management noted that this growth was driven primarily by volume.
Selling more units.
Yeah, putting more physical units onto more wrists, not just jacking up the ASPs.
And what stood out to me is the demographic shift here. Management noted that the vast majority of these purchases in the fitness segment are coming from customers who are entirely new to the Garmin ecosystem.
They are capturing net new market share, which, completely contradicts the dominant narrative that has hovered over Garmin for the last 10 years.
Oh, the old bear case.
Right. The persistent bear case was always that Apple, Samsung, and Google would eventually commoditize the smartwatch.
The assumption was, well, since everyone already has a smartphone, they'll just buy the companion watch from the same manufacturer.
And Garmin would just be squeezed into this tiny, irrelevant niche of like extreme ultra marathoners.
But the exact opposite is happening. Consumers are experiencing fatigue with the wrist computer paradigm.
Yeah, I mean, an Apple Watch is brilliant, but it requires charging every 18 hours. It's essentially just an extension of your phone's notification stress.
Right. And Garmin leaned heavily into the physics of endurance. They utilized memory in pixel or MIP displays alongside highly optimized internal operating systems.
So they're delivering watches that measure battery life in weeks, or even months if you factor in their solar charging glass.
They differentiated by being an instrument, not just a smartphone accessory.
And the influx of these new users drove the fitness segment's operating income up 50% year over year to $726 million.
50%.
Yeah, the operating margins in that specific segment expanded a massive 360 basis points to 31%.
That's huge.
Yeah.
When a hardware company sees margin expansion coupled with explosive volume growth from new user acquisition,
It indicates extreme pricing power and a highly desirable product market fit.
and the ecosystem lock-in that follows is the real prize here, isn't it?
Oh, absolutely. The switching costs are insane.
Right. Once a runner or a cyclist or even just someone tracking their sleep accumulates 2 or 3 years of highly granular, continuous physiological data inside the Garmin Connect app.
The switching costs become impossibly high. You cannot easily port a decade of VO2 max history, training load metrics, and resting heart rate trends over to an Apple Watch.
You are locked in. When it's time to upgrade your hardware, you just buy another Garmin.
The recurring nature of those hardware upgrades acts almost like a subscription.
It really does.
Yep.
But Garmin is not a monolith. The fitness segment gets all the headlines because it's the most consumer-facing, but their diversification across highly specialized industries is what builds the fortress.
Let's talk about the marine segment. It grew 18% in the fourth quarter and 10% for the full year, hitting $1.18 billion.
And they did this in a macroeconomic environment where boat sales have actually been quite choppy and uncertain.
They achieved that growth by totally abandoning the race to the bottom and just dominating the premium tier.
Right. They rolled out the GPSMAP 9000 lineup. These things feature massive 4K resolution displays for boat chart plotters.
Which is no joke. Rendering a 4K image while actively processing immense amounts of sonar data on a boat that's slamming into waves at 40 knots.
It requires serious computing horsepower and thermal management.
Yeah, they are cornering the market for large multi-engine center consoles and yachts that require complex integrated networks.
They also launched Garmin Onboard, right? That wireless man-overboard safety system.
Yes, it actually won a major marine design award. The engineering challenge of a man-overboard system is immense.
Because you need a wearable transmitter that can instantly and reliably communicate with the boat's primary navigation system the microsecond it hits the water.
Exactly. It has to override the autopilot to stop the vessel, drop a GPS waypoint, and it has to do all of this in a highly corrosive saltwater environment.
Solving those extreme engineering problems is exactly why the National Marine Electronics Association has named them Manufacturer of the Year for 11 consecutive years.
11 years in a row. That is absolute monopoly-level dominance in mindshare.
It is. But if you want to see where Garmin is truly printing money, we have to look at the aviation segment.
Oh, man. The aviation numbers are wild.
Full-year revenue was up 13% to $987 million. And the margins in this division, they are staggering.
We are looking at a 75% gross margin and a 26% operating margin.
A 75% gross margin on hardware. That is the kind of metric you usually only see in software-as-a-service companies.
It reflects the immense barrier to entry in aerospace. To get a piece of avionics equipment certified by the FAA takes years of rigorous testing, documentation, and literally millions of dollars in compliance costs.
But once a system like Garmin's is certified and integrated into an airframe, it is almost never ripped out.
Never. And they're building things that border on science fiction now.
The transcript highlighted a specific event regarding their Autoland system, didn't it?
Yeah, this was incredible. In December 2025, a pilot flying over the Rocky Mountains experienced rapid depressurization.
This was in instrument flight conditions too, meaning zero visibility.
Right. The pilot was totally incapacitated. The Garmin Autoland system activated, took complete control of the aircraft's hydraulics, throttle, and navigation.
It communicated with air traffic control and physically landed the plane safely.
Saving the lives of everyone on board.
Wow. When you are selling an autonomous, life-saving robotic pilot that can physically fly a plane to safety when a human fails,
You do not have to compete on price. The value proposition is just absolute.
and they are successfully taking this highly advanced commercial technology and crossing over into the defense sector now.
Yes, the earnings call noted that the Garmin G5000H cockpit system was selected to modernize the Brazilian Air Force's fleet of UH-60 Black Hawk helicopters.
Which is a really fascinating capital allocation strategy.
Yeah.
An analyst on the call actually asked if Garmin was attempting a pivot to become a defense contractor like Lockheed or Raytheon.
But management clarified that global militaries are shifting their procurement strategies. They don't want to spend 10 years and billions of dollars developing bespoke, hardened military-spec computers for every single utility helicopter anymore.
They're increasingly relying on commercial, off-the-shelf technology.
Exactly. So Garmin doesn't have to change its business model or spin up a classified R&D division. They just take the incredibly reliable digital glass cockpits they already perfected for commercial helicopters and sell them into massive, sticky defense budgets.
It is pure, high-margin, incremental growth utilizing existing intellectual properties, just ruthless efficiency.
It really is.
And we see a similar strategy of leveraging existing IP to create new revenue streams in their outdoor segment too. That division pulled in $2.05 billion for the year, which is a 5% increase.
And this division is heavily anchored by the Phoenix 8 series and the Phoenix 8 Pro. But the critical technological wedge here is their inReach satellite technology.
Right. The integration of the Iridium satellite network into a wrist-worn device is a massive leap.
If you are a backcountry skier or a hiker operating beyond the reach of terrestrial cell towers, having two-way SOS communication on your wrist is a fundamental safety requirement.
But the genius of the inReach integration is the business model shift it enables.
Yes. The hardware, the watch itself is a one-time high-margin transaction. But to use the satellite functionality, you have to pay a recurring monthly subscription to Garmin.
And during the Q&A, analysts zeroed in on the attach rate, trying to figure out what percentage of Phoenix buyers are actually activating that monthly fee.
The CEO confirmed that the Phoenix 8 Pro was engineered specifically as a connectivity platform because the satellite hardware is baked directly into the device rather than requiring a separate, bulky handheld unit.
The friction to subscribe is nearly zero.
Exactly. Customers buy the watch for the hardware, but they activate the subscription for the peace of mind.
So Garmin is quietly building a highly predictable, highly profitable software and services revenue stream right on top of its hardware foundation.
It paints a picture of a company just firing on all cylinders. Fitness is exploding, marine is capturing the high end, aviation is running 75% margins, and outdoor is building recurring revenue.
Having established that Garmin's foundation is currently bulletproof, let's shift the timeline forward and hit pillar number 3, management guidance. What are they promising investors for the upcoming year?
Well, 2026 revenue is guided to hit $7.9 billion.
Which is approximately 9% growth.
And operating income is projected to cross the $2 billion threshold for the first time ever, with a 2026 pro forma EPS guided at $9.35.
Plus, the shareholder returns they announced are massive. A proposed 17% dividend increase to $4.20 per share, plus a newly approved $500 million share repurchase program running through 2028.
Those are fortress-level capital return metrics.
But there's a big but here, if we are doing a true diagnostic deep dive, we have to look at the dark spot on the X-ray.
Ah, yes. The fifth segment, the auto OEM division.
The auto OEM segment is the friction point in this entire report. For the full year, revenue in this division increased 9% to $665 million.
Yeah.
But the gross margin collapsed to a painful 17%.
And the segment posted a glaring operating loss of $49 million for the year.
A $49 million crater in a year where literally everything else broke records. And the way management handled this on the call is generating a massive amount of debate.
Yeah, embedded in that deeply bullish guidance was a major structural change in their reporting.
Right. Management abruptly announced that they will no longer provide individual segment growth targets.
They're only going to provide guidance on the consolidated top-level numbers from now on.
Which instantly trips the alarm bells for any financial analyst.
Yeah.
I mean, is management trying to hide a struggling division here? Are they dropping segment targets to hide the bleed in the auto OEM division?
It is the most logical, skeptical conclusion. It looks like they're hoping the sheer volume of the fitness revenue will mask the fact that they're burning cash trying to be an automotive supplier.
Are they sweeping that $49 million loss under the rug?
Well, If we unpack the mechanics of what Garmin is actually building for the automotive sector, this reporting change looks less like a smokescreen and more like a deliberate strategic pivot.
How so?
They're trying to force Wall Street to change its valuation model because Garmin is not building cheap plastic GPS units to stick on a windshield anymore.
Right.
They're building domain controllers.
Okay, we have to define what a domain controller is because it is central to the future of the automotive industry.
Go ahead.
For decades, a car's electronics were completely decentralized. You had a tiny, separate computer, an electronic control unit, or ECU, just for the power windows.
Another ECU for the radio, another for the seats.
Exactly. A modern luxury car might have over 100 separate computers that can barely talk to each other.
And automakers are desperately trying to move to a software-defined vehicle architecture now, where a few massive, powerful domain controllers act as the central brains.
Running everything from the digital dashboard displays to the infotainment, cabin sensors, and AI assistants.
And Garmin is designing and manufacturing those central brains. They recently announced a major collaboration with Meta to explore advanced AI-driven interactions within the vehicle cabin.
But the development cycle for a domain controller is brutal, isn't it?
Oh, it's intense. You are dealing with automotive-grade hardware requirements, extreme temperature tolerances, and multi-year lead times.
So securing a contract means spending tens of millions of dollars on R&D years before a single car ever rolls off the assembly line.
Which perfectly explains the $49 million operating loss today.
During the call, the CEO addressed the volatility of automaker projections too. They had previously guided for $800 million in auto revenue and missed it.
Because legacy programs rolled off, specifically an older contract with BMW that peaked and is now winding down.
But the massive prize they just secured.
The Mercedes-Benz contract.
Yes. A program-wide contract with Mercedes.
That Mercedes contract is the inflection point. Garmin's domain controllers will be broadly applied across the entire Mercedes passenger car portfolio, with significant production volume slated to ramp up in 2027.
So management is absorbing the R&D costs and the operating losses. Now is the price of admission to get deeply embedded into the architecture of one of the world's premier luxury automakers.
Right. In 2026, they actually expect auto revenue to dip slightly due to the BMW roll-off, but they project the operating losses to narrow as they complete the heavy R&D lift for Mercedes.
Viewed through that multi-year lens, dropping the segment targets trains Wall Street to value the whole machine, rather than punishing the stock over a cyclical dip in one single category.
Management is essentially saying, we have deliberately engineered a diverse portfolio where the massive cash generation of our aviation and fitness segments fully funds the deep tech investments required for our 2027 automotive pipeline.
It is the ultimate luxury of having a diverse, vertically integrated business model. They can afford to be patient.
Exactly. They don't need the auto OEM segment to be profitable today because the rest of the business generated $1.4 billion in free cash flow this year and is projected to generate another $1.4 billion next year.
Which brings us to the final pillar, the bottom line. With the numbers, the operational story, and the future guidance all laid out on the table, what is the actual actionable takeaway for someone holding or considering taking a position in ticker GRMN?
Well, synthesizing all this data, the supply chain physics, the market dominance, the automotive investments, the data presents a company with $4.1 billion in cash and marketable securities.
And carrying essentially zero debt.
Zero reliance on a single product category, too. They've insulated themselves against geographic supply chain shocks and global tariffs through rigorous vertical integration.
And they have definitively disproved the thesis that smartwatches are a zero-sum game won only by smartphone manufacturers.
So my opinionated verdict on the data is strongly bullish, primarily because of the severe switching costs they've established.
The ecosystem lock-in.
Right. They have captured millions of new users, locked their health data into a proprietary ecosystem, and are now layering highly profitable satellite subscriptions on top of that hardware base.
If you are holding or considering GRMN, this is your classic sleep well at night stock.
Absolutely.
It gives you the explosive top-line growth of a fitness hardware company, the monopolistic margins of an aerospace defense contractor, and the capital returns of a mature value stock.
Evidenced by the 17% dividend hike and that $500 million buyback floor.
Plus, a management team that consistently underpromises and overdelivers, absorbing massive macroeconomic hits without compromising their long-term R&D pipelines.
The operational excellence is just undeniable.
So to quickly summarize the absolute most critical takeaways before we wrap. Record revenues driven by fitness dominance, vertical integration shielding their margins from tariffs, and strong 2026 guidance with a juicy dividend hike.
But as we synthesize the entire earnings transcript, there is one final, highly provocative angle that I think the market has not yet fully priced into the stock.
Oh, what's that?
We touched on the InReach satellite subscriptions, but the Connect Plus app is evolving into something entirely different.
The software layer. The transcript mentioned their recent launch of AI-based nutrition tracking and deep physiological insights on the premium Connect Plus platform.
Yes. Management specifically called out that this new AI nutrition feature resulted in incredibly high conversion rates for paid subscriptions.
Meaning users are willing to pay a recurring monthly fee for Garmin's algorithms to analyze their biometric data and tell them exactly what to eat to optimize recovery.
Exactly. Now, combine that with their recent TrueMed integration.
The TrueMed integration is a massive psychological shift. It allows customers to use pre-tax health savings account, or HSA and FSA funds, to purchase Garmin products.
Right. And by qualifying for HSA funds, Garmin devices are legally and financially recognized not as luxury consumer electronics, but as legitimate preventative medical devices.
Wow.
When you combine regulatory recognition as a medical device, AI-driven physiological software, and sticky monthly subscription revenue, the fundamental nature of the company changes.
So the ultimate question for anyone analyzing this company is this. Right now, Garmin trades at a multiple typical of a cyclical hardware manufacturer.
But at what point does Wall Street wake up to the recurring revenue, the ecosystem lock-in, and the health data monopoly, and start applying a high-margin software-as-a-service valuation multiple to this business?
If the broader market ever decides to re-rate Garmin from a watchmaker to a SaaS health and aviation platform,
the current valuation, despite the record highs, will look like the absolute floor.
the underlying anatomy of this business is stronger than the market realizes. The tariffs couldn't dent it, the memory costs couldn't break it, and the new user acquisition is accelerating.
The muddy waters of corporate earnings are thick, but the cash flow radiating off Garmin's balance sheet cuts right through it.
Well said. Thank you for joining us on this Talk Tickers Deep Dive. Keep digging into those transcripts, and we will catch you on the next analysis.